Imagine depositing $50 million into a bank and watching it disappear in less than 2 months. Not because the bank was making reckless bets, not because executives committed fraud, and not because loans suddenly stopped being repaid. The bank simply ran out of one thing: confidence. This is the story of First Republic Bank. For nearly 4 decades, First Republic built a reputation unlike almost any other American bank. Founded in 1985, it didn't compete for ordinary customers. It targeted entrepreneurs, technology founders, private business owners, executives, and some of the wealthiest families in the United States. Instead of opening thousands of branches, First Republic focused on personal relationships. Clients received dedicated bankers, fast approvals, private wealth management, and exceptionally low-interest jumbo mortgages for expensive homes. The strategy worked. Wealthy customers brought enormous deposits. The bank expanded rapidly across cities like San Francisco, New York, Los Angeles, and Boston. By the end of 2022, First Republic held more than $170 billion in deposits, over $210 billion in assets, and had become one of America's most respected private banks. To investors, it looked exceptionally stable. Its clients were wealthy, its loans rarely defaulted, its reputation was outstanding. Almost everything about the bank suggested safety. But hidden beneath that reputation was a business model built on one assumption: that wealthy clients would keep their money in the bank even when fear spread through the financial system. In March 2023, that assumption was tested. Within weeks, one of America's most admired banks would lose more than $100 billion in deposits, trigger one of the fastest banking collapses in modern history, and force regulators into another emergency rescue only days after Silicon Valley Bank had already failed. First Republic wasn't destroyed by bad customers. It was destroyed by a business model that worked perfectly until confidence disappeared. First Republic's business model looked remarkably simple. But beneath that simplicity was a delicate financial balance. Imagine one successful technology entrepreneur selling a company. After taxes, he deposits $20 million into First Republic Bank. For the bank, that deposit immediately becomes funding. Unlike an investment fund, a bank doesn't leave customer money sitting in a vault. It puts that money to work. Part of the deposit remains available for everyday withdrawals. The rest is transformed into loans that generate income. This is how banking makes money. First Republic deliberately specialized in one particular type of lending: large, low-interest jumbo mortgages. A jumbo mortgage is simply a home loan that exceeds the maximum size allowed for standard government-backed mortgages in the United States. These loans are commonly used to purchase expensive homes in high-cost cities such as San Francisco, New York, Los Angeles, and Boston. Because the loan amounts are much larger, banks usually require borrowers with exceptional incomes, strong credit histories, significant assets, and substantial financial reserves. For First Republic, that was exactly the customer it wanted. Imagine another wealthy client purchasing a $5 million home. First Republic offers a 30-year fixed-rate jumbo mortgage at an exceptionally attractive interest rate. The client receives inexpensive financing. The bank gains a wealthy long-term customer who is likely to use its private banking, wealth management, and investment services for many years. Every monthly mortgage payment generates predictable income that can continue for decades. Repeat that process not hundreds, but thousands of times. Over nearly 4 decades, First Republic built one of America's highest quality mortgage portfolios. Its borrowers were financially strong. Loan defaults remained exceptionally low. Unlike many banks, First Republic wasn't worried about customers failing to repay their loans. On paper, the business looked almost perfect. But there was one important difference between deposits and mortgages. Deposits could leave tomorrow. The mortgages could not. A customer could transfer $20 million out of the bank in minutes, but a 30-year mortgage could remain on the balance sheet for decades. As long as new deposits continued arriving, that mismatch barely mattered. The system appeared remarkably stable. Profits remained consistent. Clients remained loyal. Regulators saw a conservatively managed institution. Investors saw one of America's safest regional banks. Almost everyone focused on the quality of First Republic's borrowers. Very few asked a different question. What happens if wealthy clients don't default, but simply move their deposits somewhere else? That single question would soon become the most important one in American banking.
For years, First Republic's business model performed almost exactly as designed. Low interest rates kept borrowing inexpensive. Wealthy clients were happy to leave large deposits earning very little interest. The bank issued long-term jumbo mortgages. Everyone benefited. Then the economic environment changed. Beginning in March 2022, the Federal Reserve launched one of the fastest interest rate hiking cycles in modern American history to combat rapidly rising inflation. Within little more than a year, interest rates increased from near zero to over 5%. That single change quietly transformed First Republic's balance sheet. Imagine issuing a 30-year mortgage at just 3%. 1 year later, new mortgages across the market are being written at 7%. The old mortgage still pays only 3%. Its contract cannot simply be rewritten. For First Republic, thousands of low-interest mortgages suddenly became far less valuable than newly issued loans. But that wasn't the biggest problem. The deposits funding those mortgages were changing too. Wealthy clients began noticing they could earn substantially higher returns elsewhere. Money market funds, treasury bills, and competing banks were now offering interest rates many times higher than First Republic's traditional deposit accounts. For the first time in years, keeping millions of dollars in one low-interest bank account carried a real financial cost. The bank now faced two completely different interest rates. On one side, it continued receiving low returns from mortgages written years earlier. On the other, customers increasingly expected much higher returns on their deposits. The gap between those two numbers continued widening. Every increase in interest rates quietly squeezed profitability. Every month, the balance sheet became slightly weaker. Almost nobody outside the bank noticed. Loan defaults remained exceptionally low. Customers still appeared loyal. The bank continued reporting strong relationships with wealthy clients. From the outside, First Republic still looked remarkably healthy. But beneath that reputation, the business model was becoming increasingly dependent on one final assumption: that confidence would remain strong enough to keep those deposits exactly where they were.
On 10 March 2023, Silicon Valley Bank collapsed. It became the second largest bank failure in American history at the time. The collapse immediately shocked financial markets. But First Republic wasn't Silicon Valley Bank. Its customers were different. Its lending standards were different. Its loan defaults remained exceptionally low. Its mortgages were still being repaid. On paper, First Republic appeared significantly stronger. But banking doesn't operate only on financial statements. It operates on confidence. The failure of Silicon Valley Bank changed one question inside the minds of wealthy depositors. People no longer asked, "Is my bank well managed?" They asked, "What if everyone else withdraws before I do?" That single change completely transformed customer behavior. Imagine a technology founder reading headlines on a Friday morning. Silicon Valley Bank has failed. Financial markets are panicking. Social media fills with rumors. Friends begin messaging each other. Private investment groups discuss moving cash. Wealth advisors recommend reviewing liquidity. No one knows which bank might be next. Waiting suddenly feels more dangerous than acting. For a customer holding $20 million, moving money takes only minutes. A few taps on a smartphone, a phone call to a relationship manager, a wire transfer. The money is gone. The customer hasn't concluded that First Republic is insolvent. The customer is simply reducing uncertainty. Then another client notices, then another. Confidence begins disappearing faster than facts can spread. Unlike historical bank runs, customers don't need to stand outside branches. They don't need cash. They don't even need to leave home. Fear now moves at the speed of the internet. Within days, First Republic found itself facing one of the fastest digital bank runs in modern financial history. The hidden weakness inside its business model had finally met the one force it could never control: human behavior. The withdrawal requests didn't slow. They accelerated. Within days of Silicon Valley Bank's collapse, First Republic experienced one of the fastest deposit runs in modern banking history. By the end of the first quarter of 2023, customers had withdrawn more than $100 billion. Nearly 40% of the bank's deposits had disappeared. Under normal circumstances, a bank facing withdrawals simply returns customer money. But First Republic faced a different reality. Most of its assets weren't cash. They were long-term jumbo mortgages. Those mortgages were still performing. Homeowners continued making monthly payments. The problem wasn't credit quality, it was time. The bank needed billions of dollars immediately. Its mortgages would generate cash over the next 30 years. Selling those mortgages quickly wasn't a realistic solution. Many had been issued when interest rates were near historic lows. In a market where new loans offered much higher returns, buyers would only purchase those older mortgages at significant discounts. Selling them would lock in enormous losses. The bank found itself trapped. Its customers wanted money measured in minutes. Its assets generated money measured in decades. Recognizing the growing danger, American regulators and the banking industry attempted an extraordinary rescue. On 16 March 2023, 11 of the largest U.S. banks, including JPMorgan Chase, Bank of America, Citigroup, and Wells Fargo, collectively deposited $30 billion into First Republic. The objective wasn't simply to provide liquidity, it was to send a public message. If America's biggest banks trusted First Republic, perhaps customers would too. For a brief moment, markets stabilized, but confidence had already shifted. Wealthy clients continued moving deposits to institutions they believed were even safer. The rescue solved liquidity. It couldn't repair psychology. Over the following weeks, the bank's position continued deteriorating. On 1 May 2023, regulators seized First Republic Bank. JPMorgan Chase acquired the majority of its assets and deposits in a government-arranged transaction, making it the second major American bank rescue in less than 2 months. The crisis hadn't been caused by bad loans. It hadn't been caused by fraud. It had been caused by the speed at which confidence disappeared and the inability of even an exceptionally well-managed balance sheet to keep pace. When JPMorgan Chase completed the acquisition on 1 May 2023, First Republic Bank disappeared as an independent institution. Nearly 4 decades of relationship banking had come to an end. Its branches continued operating. Its customers retained access to their accounts. Its employees continued serving clients. But the bank itself no longer existed. For JPMorgan, the transaction created an extraordinary opportunity. It acquired billions of dollars in high-quality loans, a valuable private banking franchise, and relationships with thousands of affluent clients. The acquisition also came with loss-sharing agreements supported by the Federal Deposit Insurance Corporation, reducing part of the financial risk. For regulators, the immediate objective had been achieved. Another disorderly banking collapse had been prevented. But the events of March 2023 permanently changed how banks viewed liquidity risk. For years, many institutions had focused primarily on whether borrowers could repay their loans. First Republic demonstrated that another question could be just as important. Can the bank survive if deposits leave faster than assets can be converted into cash? The answer no longer depended only on balance sheets. It depended on technology. A smartphone could now move millions of dollars in seconds. Social media could spread uncertainty to millions of people before financial markets even opened. Private group chats, wealth advisors, and digital banking platforms had fundamentally changed the speed of modern bank runs. The banking industry entered a new era. Risk managers began placing far greater emphasis on deposit concentration, interest rate exposure, liquidity planning, and stress testing extreme withdrawal scenarios. The collapse of First Republic wasn't caused by reckless lending. Its borrowers largely continued making their payments. It wasn't caused by widespread loan defaults, and it wasn't driven by accounting fraud. It was caused by a perfectly functioning business model meeting a world that had changed faster than the model itself. First Republic believed wealthy customers would always value relationships. History proved that when uncertainty appears, speed, liquidity, and confidence become far more valuable than loyalty. The wealth bank didn't collapse because its clients were poor borrowers. It collapsed because even the wealthiest customers move first when trust begins to disappear. By the final weekend of April 2023, First Republic had reached the point where it could no longer continue operating independently. The continuing deposit outflows, combined with mounting funding pressure, had exhausted every realistic private sector solution. Regulators now faced a choice: allow another major bank to fail, or arrange an orderly takeover before financial markets opened on Monday morning. They chose speed. On May 1, 2023, the Federal Deposit Insurance Corporation officially seized First Republic Bank. When regulators seize a bank, they don't simply close the doors. Their objective is to keep the banking system operating while ownership changes behind the scenes. Branches continue opening, ATMs continue working, debit cards continue processing, online banking remains available. Customers can still access their deposits. The goal is simple: prevent panic from spreading to other banks. Over a single weekend, the FDIC invited bids from America's largest financial institutions. Interested banks reviewed First Republic's assets, its mortgage portfolio, its deposits, and the potential financial support available from regulators. JPMorgan Chase submitted the winning bid. It agreed to acquire the majority of First Republic's assets, assume nearly all customer deposits, and continue serving its clients through the existing branch network. The transaction also included loss-sharing agreements with the FDIC on portions of the acquired loan portfolio. Those agreements reduced part of the financial uncertainty surrounding the acquisition, making the rescue significantly more attractive to potential buyers. By Monday morning, millions of customers could still use their accounts almost exactly as they had the previous week. To most people, the transition appeared remarkably smooth. But behind that smooth transition, one of America's most respected private banks had disappeared forever. The rescue protected customers. It stabilized the banking system, but it couldn't save First Republic itself. Its name, its independence, and nearly 4 decades of relationship banking had quietly come to an end.